Hey guys, it's a little study time, okay? We're gonna study about martingale. What is martingale? Martingale is a probability theory, okay? Here are the history of martingale, who invented it. Very smart guys in this timeline. And here, the basic definition. A basic definition of discrete time martingale is a discrete time stochastic process. What is a stochastic process? You can check this. In probability theory and related fields, a stochastic or random process is a mathematical object usually defined as a family of random variables in a probability space, where the index of the family often has the interpretation of time. Stochastic processes are widely used as mathematical blah blah blah. So, what did you really understand it? Nothing, right? So, you don't have to go so deep into mathematics in order to understand martingale. I'm going to quickly guide you here what is actually a martingale in terms of money, in terms of trading. Okay, perfect. What is a martingale? Let's consider a coin flip. Coin flip is the classic starting point for all the probability theory discussion, believe me. Okay, a coin flip have a win rate of 50-50 for head and tail, right? Let's keep it simple. Perfect. Coin flip have a 50-50% win rate for head and tails. Now, if I tell you, for every time the head will appear, I will give you $100. That means every time head is appearing, I'm giving you $100. Doesn't sound interesting, right? $100, just $100. Come on, it deserve this taste actually deserve $1,000, right? So, okay, give me a minute. Okay, so every time head is appearing, I'm giving you $100. Oh, sorry, $1,000. Now, what is the strategy you will take if I also tell you that every time the tail will appear, you will give me $1,000? What is the strategy you will take to take this kind of trade? Exactly, the smartest, I don't know either it's smartest or not, but a strategy you can take is like you have to participate. Like you can decide either you want to participate on this game or not. Oh, my typing speed is so slow. Whatever. Okay, it's your choice, okay? I will ask you either on the next game you're gonna participate on this or not. I'm gonna flip a coin. Head will appear or tail. I'm still making it complex. I can actually describe it far more better, easy than this. Okay, the best example that I can give is not coin flip. It's actually IPL, the betting in IPL. That's going on nowadays. Like this is the stupidest thing you can do. I believe. I don't know why people are still stuck with this kind of things. But actually somehow we're actually dealing with a very similar thing in markets. Over there, guys think that they can actually analyze the team and predict either they're gonna win or not. But when it comes to trading, the trader actually also think the same thing. Like they also think that they can actually do analysis, they can actually draw support resistance, they can actually draw Fibonacci zones and breakout structure, blah blah blah, so many things in the chart, and they can predict the outcome. If you think that you're going to analyze either the next trade coin flip is going to be head or tail, you can analyze that. If you think that you can analyze that either by seeing hand movement or by seeing anything else, I'm sorry, trading is not for you. Okay, in market everything is unpredictable. It's a random walk. Okay, this price distribution has a random walk. And how we're going to make money in this is using martingale. We just need to predict. Okay, right now I'm going to discuss my system that I'm currently trading, but that's going to be too much difficult for newbies who are just starting out into mathematics. So how we're going to, okay, with every bet you are basically increasing your risk. That's basically martingale. Now mathematicians may argue that there is still a possibility of a hit coming multiple consecutive times, and I completely agree with that. Believe me, bro, I completely agree with you. I have seen those things happening to me when I actually tried to use martingale strategy in markets. But what we are actually basically trying to do is, uh, did you notice the pattern with the increase in win rate? The system actually perform better in those kind of martingale trades where you have a 1:1 risk reward ratio. So performance actually increase. And okay, I'm right now noting on my journal. So I just journaled that if the win rate is going up, the performance is going up. And similarly, if the performance is going up, that simply implies that you're actually having less consecutive losses. Okay, less consecutive losses. When you're actually using a martingale system, your win rate is increasing, performance is increasing. Uh, this is the setup you have a higher win rate, um, and then it simply implies that the performance is going to increase. Why performance is going to increase? Because the system will actually face less consecutive trades. Now, what I'm actually trying to tell you is that let's say we start a great high volume session like London session, and we are actually monitoring the price legs in 1 minute time frame, and the London session just opened. Don't you think this is a really high volume session where a lot of move is gonna happen? You can make 1 to 1 if you just take a breakout of this previous leg. That means market is going strongly bullish. Okay, we are just waiting for this kind of breaks and targeting for 1 to 1. But with my back testing, I have seen that this first trade have a win rate of just about 50%. That simply means the like we can actually uh, we're actually winning 50% of the time and losing 50% of the time. So it doesn't make sense to actually risk more on this setup, the first setup. So we're discussing about it later. Okay, just keep that in mind that this first trade setup have a win rate of 50%. So sometimes it will drop below this low, your stop loss. Okay, not sometimes, actually 50% of the times. And in this kind of situations, what you're going to do, you're going to simply short it with a sell stop, with a stop at the recent high the session has made, and you're going to target for 1 to 1. And this actually have a win rate of this second entry actually have a win rate of 58%. Great, the win rate is increasing, the edge is there. So we're gonna risk more on that. How much? Now the thing is how much. I'm also stuck with this. Like I'm trying to find the optimal risk for this based on the win rate I have. But still, I'm trying to risk. Right now, what I'm doing, I'm trying to risk a fixed amount on all the trade setups. But later on, what I'm planning to look at this. Okay, we are actually increasing our win rate till the third entry, right? And actually, we also have 80% win rate on the fifth entry. Okay, how many times actually fifth entry occurred? That's also here's the fifth entry. I don't think we have. Okay, here is the fifth entry. Okay, I need. Oh, here is the fifth entry. Okay, there are multiple fifth entries. So fifth entry have a win rate of 80%. That's a crazy win rate. So we can actually risk more on that. We can actually risk around 1,000 bucks on that. What do you think? Okay, so we're actually risking more with the win rate. We are planning to risk more with the win rate when the win rate is increasing. So if this second setup fail to manage go below this low, what we're gonna do, we're gonna again placed against order. What we're gonna do, as the price is gonna go above this, we're gonna place the stop at the current session low, and we're gonna target for 1:1. Perfect. And similar process will we will continue like this against. Okay. So let's take example of the last session. This is XA USD. We need GBP USD. Here's the trades that I took last day. So let's backtest this. Okay, we're just gonna open the session. Okay, this is the leg. Price is trying to drop below, so there is my short. Where is gonna be my stop loss? My stop loss is gonna be here. So I was risking here first. And I was waiting for price to break below. But I have seen that there is a recent structural leg, and we're gonna trail our stop at here, and we're starting with uh, 0.1 lot. We're starting with 0.1 lot. Perfect. So let's see how it unfolds. Okay, we just missed the take profit by few pips. Right now it's running upside. Okay, that's the stop out, and that simply means we're gonna take our second trade with a risk of $500 as planned. And to actually see take that trade, we need to calculate the stop loss, and we have a stop loss of stop size of 9.7 pip. So based on that, we calculate the stop loss and we get a second entry of 4.17 pip, uh 4.17 lot, and we took the trade with 4.17 lot. That was the second trade. And as I took that trade, price just smashed my TP within few minutes, and I'm done for the day. So here's the example of the system just I discussed. uh so see you soon tomorrow, guys. It's too late in the night. I'm gonna sleep. See you soon tomorrow, guys.